Hey guys, Joe Alerts here. As promised, I was going to go ahead and create a educational video for you guys. So here it is. This has taken me a lot of time to think about the content and also put it together for you guys. So with that being said, this is just for educational purposes for you guys and just to clarify some of the things that you see out there, and hopefully you benefit from it. So here it goes. We're going to be discussing options, what are options, and the difference between calls and puts, and then also what are the option lottos, option day trades, option swing trades, option leaves, mistakes people make, and some examples that we're going to put out there. And we'll try and keep this video to about 10 minutes or so. So we are going to go ahead and start with the slide that is coming up here in a few seconds. So the first slide that we're going to be looking at is what are options. And keep in mind, this is Joe Alert's explanation. I did not get this content from anywhere else. This is just based on my experience, so I'll try to put it in simple terms that each one of you can understand. So stock option simply is an agreement. So it's a contract, it's an agreement between two parties. That would be you and the broker that you're buying these contracts with, which gives you the right but not the obligation. So it'll give you the right but not the obligation, so you're not obligated to buy or sell a certain number of shares at a preset price should the stock move past a certain price you picked. That is called strike price. So if you can see the ones that I highlighted in bold font, these are the things I need to remember because you'll hear them as you trade options, so you'll know what they mean now. Strike price essentially is what you think the stock is gonna get to or past, and so that's what is called strike price. In other words, you have the option but not the obligation, thus it's called an option. You have the option but not the obligation to exercise your right by purchasing or selling, because remember there's two ways that go with stocks. You can either bet against the stock that's going down, so you sell, or you can bet that it's going up, so you buy. So that's where calls and puts come into play, which I'll get into in a few minutes. So, in other words, you have the option but not the obligation to exercise your right by purchasing or selling shares at a preset price agreed upon as the stock moves higher or lower anytime between the purchase date and the expiration date. So you don't have to wait until expiration date. You can sell it, flip it anytime between the purchase date and the expiration date. Also, the option, you have the option to flip the contract for a higher premium without exercising it, which is what majority of traders do. In simple terms, options are pretty much a cheaper way for retail traders or institutions to get stock without tying too much capital into an investment. So essentially, options are a cheaper way to get a hold of shares, and typically people are just flipping the premiums. They do not exercise and go through all these steps unless they're like a big institution that is trying to invest billions of dollars and they don't want to tie too much capital into the investment initially. So option is a contract. Each option contract consists of 100 shares. Remember that each option or each contract, whether if it's a call or a put contract, has 100 shares and has an expiration date attached to it. While options are a cheaper way to get stock by exercising your right to purchase or sell stock, they're inherently risky as it has an expiration date attached to it. This means that if the underlying stock does not move closer or beyond your strike price, remember strike price is the price that we think the stock is going to get to, the underlying stock is going to get to, or beyond, the contract you purchased expires worthless. This means that the contract is going to worth nothing, zero. So let's keep that in mind. Now, the next slide is what are calls and puts. Essentially, the difference between calls and puts. Option calls. So option calls are essentially a way to go along without tying too much capital into a stock, meaning that you're betting on underlying stock to go higher before your expiration date on the contract. The higher the underlying stock goes, the more value your option call contract gains. Again, the higher the underlying stock goes, the more value your option call contract gains. However, the closer to expiration date it gets without a movement on the stock, so say the stock is trading flat, then the less valuable your contract becomes until it becomes worthless. So that's the risk involved. Be mindful of that. Option puts are essentially the opposite of option calls. So the definition that I put out there is that option puts are essentially the opposite way of calls, and so essentially you're going short, you're not going long, and a way to go short on stock without tying too much capital into it, meaning that you're betting that the underlying stock to go lower before expiration. Now put higher, it's actually lower before your expiration date on the contract. So the lower the underlying stock goes, the more value your option put contract gains. Again, on puts, the lower the underlying stock goes, the more value your option put contract gains. However, the closer to expiration date it gets without a movement on stock, so say the stock is just staying flat and getting closer to your expiration date, then the contract becomes less valuable and it's going to be worthless eventually. So that's the risk involved. Remember, you can sell calls or put contracts, so calls or puts, without exercising them, as you always have the option to do so anytime between the date of purchase and the expiration date. So you don't have to wait until the end of the contract or the expiration date of the contract. So you can always exercise them, or you can just sell them and flip them outright. So, or you can also exercise them for 100 shares each option contract at the strike price you agreed upon when making the contract purchase, assuming that it has hit your price, your strike price or higher. Now the next slide is going to be talking about option trade strategies. These are the option lottos, option day trades, option swing trades, and option leaps. And what do I mean by that? So option lottos are extremely high risk, high reward due to the short amount of time you are working with. Therefore, they're considered lottos, as they're treated like a lottery ticket, thus the term lottos. Normally, traders buy them on expiration date. So you buy them with like an extremely short amount of time on expiration date with a strike price very close to where the underlying stock is trading now, and usually at a fraction of the price with that contract that you buy. That contract would have normally cost a lot more a month ago or even a week ago, but because it's on the same day and you have less time to work with, normally they're priced at a cheaper price, like 2 cents, 10 cents, 20 cents, anywhere from like 1 cent to $1. This is because you have less time to work with for the underlying stock to reach your strike price. The risk is that they can expire worthless on the same day, or if it goes above your strike price, you can get high returns within the same day. Returns can range anywhere from 50% to 1,000% or even more. Option lottos are a day trade, so you can't hold them for more than 1 day because they're going to expire worthless at the end of the day or expire in the money. So you have to take action on it, whether to exercise and change to shares or just flip the option contract, which is what most people do. Option lottos are a day trade within a very short time frame, with a hold time ranging from seconds to minutes or higher. Just depends on the move. So the goal is just to get the profit and get out on that same day. And so normally it moves within seconds and sometimes takes minutes. But the idea is you get these on reversal, like let's say they're killed on the day and they start reversing and they have high volatility, then you can get expiration, same expiration lotto. Just be mindful that they're highly risky, and always, size appropriately. So it would be like a small size of contracts. You don't just go all in because you could, they could expire worthless. So that's option lottos. Option day trades are a great way to capitalize on moving stock, on a moving stock that's moving higher or lower by purchasing option calls or puts. So we can't be biased. We have to pick whichever direction we think the stock is going to go. Depends on the direction with a short-term expiration date. So normally that range is within a week or 3 weeks or so. And plan to get out on the same day by taking your profits. Thus, it's called a option day trade. So just make sure you lock in your profits. Normally, hold time frames range from minutes to hours within a given day for day trades. Now we're moving on to option swing trades. Option swing trades are a great way to capitalize on an anticipated. Remember, the day trades are moving stock, so you get in. Goal is to get out on the same day. On swing trades, you're anticipating a move. It's not moving yet. You're anticipating a move, whether if that's higher or lower, by purchasing option calls or puts. Depends on the direction you anticipate it to go, based on the research and due diligence that you have done. Normally, with a longer term expiration date, normally a few weeks to a few months, and plan to get out, taking your profits once your price target is reached. Option leaps. So option leaps are a great way to capitalize on an anticipated stock move, higher or lower, by purchasing option calls or puts. Depends on the direction you anticipate it. So essentially it's the same as option swing trades, but it has longer time frames. Excuse me. So you anticipate the stock to move higher, much higher, but you want to get option leaps, and those are normally range from few months to few years, and plan to get out, taking your profits once the price target is reached. Typically this is for people that don't have time and they just want to put their money somewhere. They have done their due diligence, but they know the stock's going to reach a certain price target in a year or two or so, and so they would get in, and then eventually they would reap the harvest, as they say, and get their reward and secure profits. That's it for the option trade strategies, and then now we're going to move to an example of what an option trade might look like. This is just a high-level example, so I know we're past the 10 minutes time, but I'm going to go ahead and squeeze this in. Let's say Tesla hypothetically is now trading at $1,000 a share. Hypothetically trading at $1,000 a share. If you were to buy 1,000 shares, if we do the math and multiply 1,000 shares by $1,000, that's $1 million. $1 million US is required. That is a capital required to buy the stock. So if you were just do the traditional way in buying the stock, you would be required to have $1 million to buy the stock, but you do not want to tie that much of capital into this. So thus there is an option contract that you can buy at a lower price, which guarantees you the same amount of shares should the stock move to the strike price that you're going to pick. So in this example, instead of tying that much of capital and you anticipate the stock is going up in the next month or so, you can buy contracts betting on the stock reaching $1,100. So $1,100, let's say in 3 weeks. So $1,100 is now your strike price. Remember, the price that you bet on it to reach it or go past it is your strike price, whether that's a put or call option. So essentially, whether if you're going short or long, whatever strike price, the goal is you want it to get closer to it or past it. So in this example, you purchase at a preset price of say $1,000 per contract. Remember, each contract has 100 shares. So each share would be at $10 for this example. So 100 shares multiplied by $10, that equals $1,000 cost basis. Since the goal for this example is to secure 1,000 shares, for this example we're going to need 10 contracts. Remember, each contract has 100 shares. So we're paying essentially $1,000 per contract. Total is $10,000 for 10 contracts. Each contract has 100 shares. So that is 1,000 shares. So instead of tying $1 million, if we were to just purchase the shares outright, while the stock is still trading at $1,000, we only paid $10,000. With me still? Okay. Now, you have 3 weeks for Tesla to move 100 points or higher to reach your strike price for $1,100. Let's say you're right and the stock moves higher and Tesla gets closer to $1,100 price per share. Your contract becomes more expensive. Premiums at this point are higher now that there is a chance you hit your strike price. So it becomes more valuable. Now, if it does not move by the expiration date, you will risk losing all the $10,000 because the option becomes worthless by the expiration date if the stock does not move up or down. However, say the stock starts to move even further and goes to $1,500 per share. You now have the option, because it's gone past your strike price of $1,100 and now it's trading at $1,500 for this example, you now have the option to either sell the contracts at $40,000 each, multiplied by 10 contracts that you purchased. That's gonna worth $400,000. So you have $390,000 profit since you only paid $10,000 for all the 10 contracts. You now have the option to exercise it for shares, but at the strike price you bet on. So that's the benefit of buying contracts. You can exercise it. You have the option but not the obligation to exercise it at the preset agreed upon price. For this example, it was at preset price agreed upon for $1,100. That's your strike price. So again, you have the option to buy the stock at $1,100 per share instead of current price of $1,500. So that's the benefit. You get it at a discounted price because you have an agreement with them. You can either do that or you can turn around and sell the stock. You can either do that, meaning exercise the contracts for shares, and you could turn around and sell the stock for about the same profit, or can hold on to it longer since it does not expire. So shares essentially don't expire, unlike the contracts. Most of retail traders though make a ton of money out of basically flipping. They just flip the premiums. So instead of going through the exercise hassle and wait for the stock to go higher, why not just flip the premiums, meaning just sell the contracts outright. You don't have to exercise them and go through the trouble. So they just flip the premiums, and investment that would have otherwise required $1 million to purchase the same amount of shares would only cost $10,000. The risk involved, however, though, is that the contract has an expiration date. So if you're wrong, the contracts that you have purchased, the option contracts, will expire worthless by the expiration date if the stock stays flat or moves lower or moves against you. So essentially you're risking losing the entire $10,000, but then again, you don't have to tie up $1 million, and profits can be very, very attractive for a little investment that you put up front. With that being said, thank you for listening, and I hope you benefited from this, and take care, guys.